This film is brought to you by The Daily Upside, a free, unbiased finance newsletter that tells you exactly what the market is doing. Check out the link in the description. For 30 years, Stanley Druckenmiller has delivered 30% profit every year for his investment, an unparalleled record on Wall Street. But then at the peak of his career, he closes his $12 billion hedge fund.
At 57, having managed other people's money for 30 years, he said it was enough. He didn't want the stress anymore of managing other people's money.
Druckenmiller is a legend on Wall Street. Through discipline and an unorthodox investment strategy, he turned his humble upbringing into billions.
Fanaius.
Stanley Druckenmiller is raised in an ordinary middle-class household in Philadelphia. But there's nothing ordinary about the guy. Even from an early age, people noticed that he was unusually smart and also kind of eccentric. Even as young men, Druckenmiller dreams of something better and taking a chance. But he knows he will have to do it his own way. In spite of his intelligence, Stanley Druckenmiller was not accepted to an Ivy League school. He goes to a liberal arts college in Maine instead. But to pay for his expenses, he opens a hot dog stand on campus. This entrepreneurial experience gave him a more practical understanding of how business works. I think this is one of his hallmark traits, which is that he learns by doing rather than from theories. Druckenmiller excelled in college. He becomes a PhD candidate for economics at University of Michigan. But he quickly finds his coursework too theoretical and impractical.
I took economics just so I could read the paper intelligently. I went to get a PhD in economics, and I went there and I said, these people are crazy. They're trying to shove the economy into a math formula. It doesn't make any sense.
We have to be honest with ourselves that a lot of math has crept in for purposes of intimidation, to make cryptic, which is otherwise simple, and to create a kind of interference competition where the field could be restricted to a smaller number of players. So I think that there's a tremendous amount of abuse of mathematics.
Druckenmiller realizes the PhD program isn't going to teach him how to make money. The only way to become rich is by actually playing the game of market. He leaves the PhD program and becomes a stock analyst for Pittsburgh National Bank. At PNC, Stanley Druckenmiller learns the art of chart reading, also known as technical analysis.
Technical analysis is the analysis of stock prices, or maybe other speculative asset prices, by looking at charts of the prices and looking for patterns that suggest movements in prices.
Although most investors disregard technical chart patterns as useless, Druckenmiller believes there's always a practical explanation behind them. He doesn't look at a chart as some abstract lines. For example, during a bear run, there tend to be a falling wedge pattern. Druckenmiller believes that patterns like this are not random. Instead, they represent the behavior of real traders behind them. As a practitioner, Druckenmiller will use any technique as long as it makes him money. He quickly masters the skill of stock predictions by combining fundamental factors such as earning, industry capacity, with technical analysis.
I like multi-disciplines in managing money. So my first boss taught me technical analysis. So I use fundamental analysis and technical analysis.
His career takes off. At 25, he becomes the youngest head of equity research for the bank.
I've worked for a very eccentric, brilliant investor who made me at the age of 25, this was 1978, director of research, which was basically the number 2 position in the investment division of the bank, and I was a little confused. Also, I was a little cocky and arrogant. I was 25 years old. So when I walked in, he said to me, do you know the reason I'm promoting you above all these people? I said, no. He said, for the same reason they send 18-year-olds to work. You're too stupid and young to know not to charge.
Druckenmiller becomes a market wizard for PNC Bank and regularly gets invited to give talks to finance professionals. Impressed by Druckenmiller, a wealthy investor offers him $10,000 a month just to consult with him. It goes to show how much people wanted to listen to his views on the market. He also realizes that if people are willing to pay him that much just to speak with him, he could very well start his own fund. He raised $1 million. At the age of 28, Druckenmiller starts his own hedge fund, ΔուΚain Capital, in 1981, in a dangerously unstable market. It will be a true test of his ability. The decade of 1970s is known for its out-of-control inflation. Earlier, President Nixon abandoned the gold standard, destabilizing the currency. By the end of it, the economic suffering of the middle class has led to the election of a populist president, Ronald Reagan. But during the first year as a president, his policy doesn't seem to work. An economic crisis is looming. Behind every crisis, there's an opportunity. After starting his hedge fund at the age of 28, Stanley Druckenmiller is ready to make a fortune by riding this financial storm.
Inflation is our friend.
People don't like to raise interest rates. It's not very popular. And there was some resistance and fear of creating a recession and so forth.
The trick of investing sometimes is not about predicting a future event. It's about knowing how much other people know about this event. So in this case, Druckenmiller buys a lot of long-term bonds because people don't yet realize about this crash. And when they know a crash is coming, they will bid up the price of long-term bonds. And Druckenmiller is set to make a fortune. Druckenmiller's bear play pays off. By May 1982, an economic recession has fully materialized. He makes almost 50% profits, and more investors start giving their money to this young hedge fund manager, with a total of $7 million assets under management. Finance is an interconnected game. Sometimes it's impossible to fully avoid the ripple effect of a crash. Although Druckenmiller made great returns, one of his consulting clients went bust. His fund lost a major income source. To pay for his overheads, Druckenmiller is forced to sell 25% of his management company to raise $150,000. It turned out his difficulty was only temporary. A year later, his fund grows to $40 million. Once unable to pay for his college tuition, now Druckenmiller is about to make more money than what he could possibly dream of. Like all investment funds, mutual funds started out by delivering impressive returns to their investors in the early 1980s. Founded by the dynamic investor Jack Dreyfus, Dreyfus Funds is one of the pioneers in the mutual fund industry. But as any industry grows, competition leads to lower profits. Dreyfus fears that if their fund does not outperform the market, it will go under. They must find someone who represents a new breed of investors who aren't indoctrinated by the old investing paradigm. Stanley Druckenmiller seems to be the most likely candidate for them, but he isn't about to quit his own profitable fund and joins Dreyfus. Dreyfus is willing to accept any conditions from him as long as he agrees to run their fund. From Dreyfus' perspective, they're looking at Druckenmiller as a money-making machine that could double or triple their assets in just a few years. Hiring Druckenmiller is a genius move. At Dreyfus, he actively trades stocks, bonds, and currencies. His performance outshines every other money manager at the company. Druckenmiller continues to hone his unique trading strategy, which is a combination of valuation and technical analysis. Determined to get the most out of this young talent, Dreyfus decided to let him take over 5 funds all at the same time. By the end of 1986, all of them are up at least 40%. It's hard to see that kind of returns today for essentially a collection of mutual funds. Reagan's economic policies led to a boom in the stock market.
They love the fact that shoppers are out in full force and say business has never been better.
With an audacious trading strategy, Druckenmiller makes tens of millions of profits for a mutual fund company called Dreyfus. His use of technical analysis allows him to time the market, a skill mastered by few. But what worked in the past may fail to work today. That seemed to be the issue with chart rating. Because the market doesn't always react the same way, especially during periods of extreme volatility. Druckenmiller is about to learn this lesson the hard way. Trading is a competitive game. To have an edge over your opponent, it all comes down to information. I want to thank the Daily Upside for sponsoring this video. The Daily Upside is a free business and investing newsletter that over 200,000 people subscribe to, myself included. In today's internet age, the signal-to-noise ratio is unbelievably small. That is why a group of former investment bankers, journalists, and scholars came together. They started the Daily Upside with the intention to provide a clear, precise picture of the market. Instead of pushing clickbait headlines and biased news, the Daily Upside provides you with news information that you can actually take actions on. Every weekday, they deliver a morning brief followed by more detailed stories that are shaping the business world. I'm a big believer in creating impactful content, and I think the Daily Upside is doing exactly that. They provide high-level, unbiased analysis that will help you stay ahead of your game. Click the link in the bio and join me to read the Daily Upside every morning. The warning signs of stock market crash are evident. Economic growth has slowed while inflation is still climbing. The strong dollar is putting pressure on US exports. The stock market is getting overvalued with a PE ratio way above 20. Druckenmiller knows the market is set for a correction. A bubble is destined to burst eventually. To pull the trigger on shorting the market, he needs to verify that his technical indicators are in place. But on Friday, October 16, 1987, he sees all the technical signals to suggest that the bull run will continue for a while. Since the Dow has come down to 2200 from 2700, he believes it was oversold and that there's a tremendous support near that 2200 level. It will likely go up the next Monday. So he goes all in the stock market and even borrows 30% to boost his potential returns. He executes his trades just before the market closes and has to meet his mentor, George Soros. Like Druckenmiller, Soros has built a strong bull position on the market, hoping to catch one last ride before it crashes. During the meeting, Soros shows a report to Druckenmiller written by a relatively unknown money manager, Paul Tudor Jones. In the report, Jones demonstrates a historical pattern that Druckenmiller was unaware of. Paul Tudor Jones convincingly lays out his argument that a crash is imminent. Druckenmiller falls into a great panic. He devises an exit plan. Come next Monday morning, if the Dow drops anything below 30 points, he will sell his entire position. Fortunately, that morning, the market didn't quite grasp that a storm is here. It actually bounced back from that negative 200 points. For Druckenmiller, he got out without losing much money. He actually went net short. By the end of October 1987, Wall Street is in ruins. Even Soros lost $200 million. But Druckenmiller's fund actually went up, all thanks to his quick actions to cut losses on that fateful morning of 1987.
Most investors lack discipline. They get excited when things are great in a situation, and it's usually already in the price. I think as long as you're disciplined and you stick to it, you make money. I have the polar opposite investment philosophy. I'm a put all your eggs in one basket and watch the basket carefully.
Even though Soros lost money on Black Monday, Druckenmiller's admiration for him hasn't diminished. George Soros is perhaps the greatest speculator in finance. In his first decade running his quantum fund, he achieved 3,000% return. The 1987's crash makes Soros want to retire. Soros knows, without audacious risk-taking, his fund's performance would diminish. He needs to find someone to take his place. Impressed by Druckenmiller's ability to time the market, Soros believes he is a perfect successor. Druckenmiller independently discovers that there's a dance between market fundamentals and its price. It is like Soros' theories of reflexivity, which holds that there's a feedback mechanism between market fundamentals and market pricing. At age 36, Stanley Druckenmiller becomes the second most important guy in quantum fund. But to become number one, he needs to impress his boss even more. Soon, a historical world event will present him an opportunity to do just that. With the Berlin Wall coming down, the Deutschmark falls with it. Druckenmiller sees this as the best opportunity to buy the marks. Typically, when there's a budget deficit increase of a country, its currency value tends to decrease. But there's an exception to this rule. In Soros' book, The Alchemy of Finance, he argues that fiscal deficit plus expansionary fiscal policy plus tight monetary policy equals increase of currency value.
The wall came down. I had a very, very strong belief that Germans were obsessed with inflation. And when the wall came down and it looked like they're going to merge with East Germany, the world's thesis was, this is going to be terrible for the Deutschmark. My thesis was the Bundesbank is the most powerful institution in Germany. The public's obsessed with inflation, and they will do whatever it takes on the rate side to keep that currency strong, and there's no way the Deutschmark is going down. In fact, the place is going to grow like a weed with all this labor from Eastern Germany.
He goes all in, building a position worth $2 billion.
We were all revolutionaries, and the revolution has been a success.
1989 is the last year of Reagan's presidency. Under his rule, America has been on a roller coaster ride. He leaves the Oval Office with a $220 billion deficit. The US economy is at a turning point. After just 3 years running the Quantum Fund, by 1992, Druckenmiller has nearly tripled the fund's assets solely for organic growth, a record surpassing that of even Soros himself. As the US economy is shaking and the world gets more chaotic, Druckenmiller is ready to capitalize.
C'est un très grand honneur que vous m'avez fait en m'appelant à la présidence du Parlement européen.
When Europe got together to form the Eurozone, I think it was probably one of the greatest accomplishments of mankind ever. It was an amazing thing that all those countries, after centuries of war, not just World War II and World War I, but Napoleonic Wars, Franco-Prussian Wars, 100 Years War, War of the Roses, 30-year war, got together, and you think you can hold hands and say, can we learn to live in peace?
To forge the EU as a collective economy, they set up ERM, the exchange rate mechanism, in 1979, hoping to gradually transition to a single currency. But Western Europe is a collection of countries with vastly different cultures. Some value hard work and discipline, while others value leisure. But by 1992, strong currencies like French franc and German mark carry the rest of the weak currencies.
But joining the ERM failed to bring instant prosperity. Britain had already been sliding into recession. Over the next 18 months, it got much worse.
After Britain suffers a recession, it becomes harder to maintain the ratio of pounds against German mark. To save their economy, the Bank of England will have to print more money, which breaks the ERM, or the British economic suffering will get even worse. Typically, when a central bank prints more money, the currency value will decrease and the stock market will go up. This is what should happen with Britain, but the central bank is very hesitant to act. A crisis is brewing. To Druckenmiller, this is a potential killing of a lifetime. Just before pulling the trigger, he consults Soros.
I'll never forget, I walked into his office and told him the fund at the time was $7 billion, that I wanted to put a $7 billion position on long the Deutschmark and short the pound. I explained my reasoning to him, which I thought was very sound. He looked at me with like the most disgusted look, and I was getting angry just with the body language feedback I was getting. And he said, look, you only get an opportunity like this. This is a one-way bet, maybe 2-3 times in your career, and you're just not betting enough. We shouldn't put 100% of the fund in this trade. We should put 200% of the fund in the trade, because the most you can lose in it is 0.5%, and you can make 20% in it. So your risk reward is tremendous.
I said, go for the jugular, go for the kill.
Rather than simply shorting the weak currencies, he also bets on the security markets that will be affected by the currency realignment. By September 10th, after Soros and Druckenmiller fully execute their trades, they wait.
Today has been an extremely difficult and turbulent day. The government has concluded that Britain's best interests are served by suspending our membership of the exchange rate mechanism.
When the dust settles, Quantum Fund pocketed $1 billion profit. Under Druckenmiller's management, Quantum Fund goes up 69% in 1992 and 72% a year later. Hiring Druckenmiller was the best investment decision made by George Soros. Druckenmiller has made more money for Soros than he could have made himself. By 1999, Quantum Fund has grown to have $8.2 billion assets. Based on their past performance, they can make another $2 billion the year after, except the market has changed. Such a change will throw everything they learned about the market out of the window and make them rethink about what it means to be a trader.
Computers are supposed to make life easier. About 1 in 3 American households has bought that theory and purchased a PC.
By the late 1990s, the age of information has dawned.
If you don't get on this technology boom, if you don't compete, if you just kind of look around and resent that you're falling behind, you're going to just be left in the dust. You're going to miss the whole thing.
Even though Soros and Druckenmiller have been making ungodly amount of money using their knowledge of the market, they are unaware that a deeper change is happening. The effect of technology and information is a pattern they haven't seen before. In 1998, Druckenmiller realizes tech stocks represent an opportunity for a massive return. Based on his knowledge of stock patterns, he makes a healthy profit that year. By the start of 1999, he doubles down. But he ignores one factor. Small retail investors have flooded in as never before.
That was virtually a new development on Wall Street. Before that, the players in finance are professionals whom Druckenmiller understands. He knows their behavior and made a bloody fortune out of it.
The massive participation of retail investors makes the market structurally unstable.
From its peak in 2000, the Nasdaq Technology Index had lost 3/4 of its entire value.
Druckenmiller suddenly finds himself in an unfamiliar situation. By April 29, 2000, Quantum Fund is down 22% for the year.
In January of 2000, after riding that tech boom to a T and making billions of dollars in '99, I sold everything out in January, and I had a couple of internal portfolio managers at Soros who didn't sell out, and they had it was a smaller portfolio, but they made 30% after I sold. And I just couldn't stand it anymore. I'm like watching them make all this money every day. And like for 2 days, I'm like ready to pick up the phone and buy this stuff back. And you know, there's a little devil there, and then the angel, and she's saying, don't do it, and he's saying, buy it. And I pick up the phone and I buy them. I might have missed the top of the dot-com bubble by an hour. I ended up losing $3 billion.
Unable to accept his failure, Druckenmiller quit Quantum Fund and goes back to solely managing his own ΔUK Fund.
I had quit Quantum and Duquesne was down 15%. And I had given up on the year, and I went away for 4 months, and I didn't see a financial newspaper, I didn't see anything. So I come back, and to my astonishment, the NASDAQ has rallied back almost to the high.
Druckenmiller immediately realizes that this is a chance to recover his previous losses.
And the price of oil has gone up the dollar's gone way up, and interest rates have gone up since I was on my sabbatical. And I knew that normally this particular cocktail had always been negative for earnings in the US economy. So I started buying very large positions in 2- and 5-year US treasuries. So I keep buying these treasuries, and Greenspan keeps giving these hawkish speeches, and they have a bias to tighten. And I'm almost getting angry, and every time he gives a speech, I keep buying more and more and more. And that turned out to be one of the best bets I ever made. And again, there was no price movement. I just had such a fundamental belief. So sometimes it's price, sometimes it's just such a belief in the fundamentals.
In 2008, his fund achieves a positive return, while the rest of the market is gutted. But he comes to realize that it is getting more difficult to maintain his performance.
By 2010, the world has changed beyond recognition. Never in history have the world economies been so interconnected.
Druckenmiller decides to return his investors' money and stops trying to live up to his past performance.
Well, let's be clear, I'm not making 30% a year anymore since I retired, and I'm not running the size I used to, and I do feel like I left so much on the table.
However, since his retirement, the market has entered into an unprecedented boom. The structure of the market has evolved even further, and retail investors once again are flooding the market.
There have been a number of instances over my career where it was very clear to me that the world had changed. The world changed on 9/11. The world changed when the wall came down in Germany. The world changed the night Donald Trump was elected. And these set in place usually 2 to 4 year trends of concentric circles you can play. And I've always felt comfortable, again, I'm not the man I used to be, of jumping in big with a thesis, and if it's working, staying with it.
Thanks again to Daily Upside for sponsoring this video. If you haven't subscribed already, click the link in the bio to receive their weekday and weekend edition absolutely free.